model we'll create, and you can play around with it, but we want to see what is the impact of our double taxation for a C Corp compared to an S Corp. And we want to see if you do different dividend payouts. Let's say I want 100% paid out to the owners, or if I want zero paid out, who benefits more, who benefits in retained earnings, who pays a higher tax rate, and then we can see the impacts of debt as well. So let's get into our model, and this is going to be the C and S Corp model that we're using here. So just a reminder, what you want to do on all my models, you want to put your name, and then the username is either going to be your email address, and in our case, it's going to be our username for our school. So we're just going to type that in. And once I hit enter, I'm going to look at it, it timestamped it, and then I want to have that OK checked just to make sure it worked right. Okay, let's go to our CNS model here. What we have here is we have our assumptions. This is real important. I unlocked it for you that you can play around with it. You can see and adjust it to see the impact that it has on our model. So here's our assumptions, and then here's our C Corp and S Corp. And I'm going to slowly go down and talk about each one. We'll see how that works in that regard. So first thing I want to show that we have EBIT. What is EBIT? That's operational income, earnings before interest and taxes. That's what we want first. That's what a lot of the questions will be for this kind of example. We got corporate tax rate. Who pays the corporate tax rate? We got debt, which I'm going to introduce at the end. We got personal income tax. Remember, personal income tax is on dividends, stuff like that. Dividend payout rate. What percent of the company, what percent of our earnings that the owners or the after-tax corporate income, what percent is getting paid out as to the owners, and then the remaining must be paid out as investment into the company or retained earnings. And then also this example, I'm making an assumption, some of my questions will have that, is the number of stockholders 100, and we're making the assumption each own 1%. So if you're not in my course, you probably like, why have that? Yeah, this is just for a question that's in my course. So let's start plugging it in. The first part, this is almost like an income statement. After we did revenue and cost of goods sold, selling, general administrative, all that stuff, and depreciation. Now we got EBIT. So all we have to do is plug those values in. And I'm going to just go from the C to the S, and then we will slow down when they differ. So then we want to know the interest. Well, the interest is, well, how much debt do we have? Even though it's zero, you want to make sure your model is dynamic, as in if I changed this and I put $1 for debt, I want this to be impacted as well. So I'm going to do the debt outstanding, and I'm going to multiply it times the interest rate. And we'll do the same here, no difference. And then we got our EBT. So right now, it doesn't look like there's much difference. So I'm going to select the EBIT. I'm going to hit subtract, and I'm just going to hit the arrow up. You notice it kind of covers that cell, a little hard to select it. And that's going to give that to me. And then, so right now, nothing is different between the two. So now this is where it's going to change. So the C Corp has a double taxation impact for a double taxation that they could have a double taxation. So maybe I got to make that clear. It doesn't mean it is a double taxation, but they could have it. And what we have now is we have the corporate taxes. The S Corp doesn't have it. The C Corp does. So what we're going to do is we got the corporate taxes. I'm going to select the EBT, the earnings before taxes, and then I'm going to multiply it times the 21%. All right. So I'm going to do this to show that you can do this two ways. I have the taxes here, so I could go like this. I could go, well, what's the EBT minus that? That would be correct. Another way you could do it, if you didn't want to subtract out the taxes, this is almost like a quick step without showing the taxes. I could do the EBT, and I can multiply that times 1 minus the tax rate. Let me just explain what that is. If we subtracted out the taxes, I would multiply it times the tax rate to get the taxes and then subtract it. However, if I do 1 minus the taxes, that means 21% is what I have to pay. That means 79% is what I keep. So that is the same exact way of doing it, right? I could either find out the taxes and then subtract it, or I can multiply it times 0.79 or 1 minus the tax rate. Just want to show you at those two examples. Now for the other company, we don't have a S corp. We don't have a corporate tax. What we have is 100% of EBT has to be taxed at the personal income tax. So what I'm going to do is I'm going to take that EBT and I'm going to multiply that times a larger personal income tax, 35%, the corporate income tax, 21%. So you guys see what's going on, that we will see the C Corp might have a double taxation if we pay out dividends. And then that's the personal income tax. However, the S Corp has to pay 100% of the personal income tax of that money. So right now, as you can see, that the S Corp is paying more taxes so far because it has to pay a 35% rather than the 21. So now what we can do is we can go to the EBT and we're going to subtract out the taxes. And now we have a impact right here. Now the S Corp has less money because they had to pay a higher tax rate. Okay, let's go to dividend payout rate of 100%. And then what we're going to do here is I want to know how much money is getting paid out to the shareholders. This is total, right? We have 100 shareholders equal both all 100 own 1%. So right now I want to know how much money is going to the shareholders. So I'm going to take that after-tax corporate income and I'm going to multiply times what percentage is going to the shareholders, right? And then I'm going to do the same here. And that's called cash distribution to the owners. So I'm going to take that after tax, or you can call it net income on the income statement, net earnings, net profit. And I'm going to multiply that times that payout rate. So they're equal. And to show you, if you do it right, I can go 90% and it automatically will adjust and you can see the impact of it. Now we want to know, well, how much, so if the shareholders, you own Google stock, you own Lowe's stock, and if they pay you a dividend, I have to pay, that's income coming to me, I have to pay my personal income tax on it. And just a brief little summary of the personal income tax. You want to think of personal income tax as income. If you own an asset like a house, that's capital gains tax. If I own a stock and I bought it for 500, sell for 550, I make $50. That's capital gains. That's important to see. So we're going to take that, how much money is paid to the owner. I'm going to multiply it times that personal income tax. I'm going to finish up the C Corp on this side. And then what I want to find out is, well, how much money is coming to the shareholders? So I'm just going to subtract out the taxes. And then what I want to know, well, there's two things that after the income statement you can do with your money, with your net income. You could pay the shareholders that we did 100%, or you can reinvest it back into the business. So this, what I'm going to do is I'm going to go to retained earnings. I'm going to go equals this minus what was paid to the shareholders. The difference between that must be the retained earnings, right? So if I change it to 90%, right, you'll see that adjust. That means this, right, dividends paid 90% plus this would equal that total after tax corporate income or net income. So those two things must be equal to it. So very simple. I just do that minus the dividends paid out must be what is retained back into the business. And if you look at here, if I do 0%, look at that. All 100% was paid back into the business. 0 is paid to as dividends. So let's go back to our 100%. Let's finish up the C Corp. Remember double taxation. The double taxation is if it's paid as dividends. So we have double taxation. If this was 0%, there is no double taxation because there's no dividends paid. So at the beginning of this video, I said there may be double taxation, not always. It depends if there's dividends paid to the owners. High-tech stock, high-growth stocks do not pay dividends. They reinvest 100%. And as you can see, the personal income tax, right? On an S Corp, if you're a high-growth company and you're reinvesting it, look what you're doing. You're paying 35% into the taxes when the corporation is only paying 21. All right, next we want to find out what's the cash to owners. Well, there is no double taxation. We already paid our taxes. That's always equal. And then I want to know what is the retained earnings, the reinvestment. As we see, it's 100%. That will be zero. What I'm going to do is, well, this is the after tax minus our cash to the owners. The difference must be the retained earnings. And just to play around with it really quick to make sure I did it correctly, 90%. Everything lights up green, which means you are on your way to a good model. I'm back at that 100% dividends. Now let's look at what is our total taxes paid. So I'm going to go equals, double taxation. So I'm going to find the corporate taxes, and then I'm going to find the plus the taxes for the dividends. So total taxes paid $778,400, and then this one's a little bit easier because we only have one taxes, personal income tax. So now you can see right now, since we paid dividends, the corporate taxes is getting hit harder with the double taxation. And if I lower that dividend payout rate and we're reinvesting it back in, as you can see, then the S Corp is paying more because this is not being double taxed as much. And now the double taxation is zero. And then this is paying a lot more because this had only 21% and this had a 35%. Let's go back to our 100%. Now the last couple things, and I'm going to do something that may look correct, and then I'm going to show you it's not correct, and I'll show you why. Now we want to know, what is the owner effective tax rate? We want to know what is the total tax rate that the company has to pay. I'm going to go equals, and what I'm going to do is I'm going to add up all the taxes, which I already did, and I want to divide it by our EBIT. And this will show what percentage of taxes we had to pay. I want to divide it by our EBT. No, I'm sorry, I'm doing it wrong. Our EBIT. I'm thinking wrong on it. Apologize. So, okay, so we want to see what is our tax rate, 48.65%. I'm going to show, well, I don't think that would work. Wait, I was thinking something else. Okay. So that you want to have the total taxes divided by the EBIT. And then we want to find out, now this is going to be wrong, but it's going to look like it's right at first. So I'm going to go equals. Well, what is the tax rate here? Well, obviously it's 35%, right? That doesn't change. I mean, if I go, look how this adjusts. Let's do 7%. Look, the tax rate went down. This is 35%. So that looks like it's correct, but we're going to change something in a second. And the last part, and I'm going to revisit the tax rate, and we're going to see the different impacts. Let's go. What is the spendable income per stockholder? The only reason I'm including it is because in my courses, we do have a question that has 100 stockholders that each own 1%. So all we have to do here is go equals. I'm going to take the after-tax cash to the owners, and I'm going to divide it by the 100. So we can see the impact of that. And then this would be the same example. I'm going to take the cash to owners. I'm going to divide it by the 100. So this is all complete. And now we could do a little bit of playing around on it. One thing I got to do here. I don't want decimals. Okay. So now let's play around with a few things here. So as you can see, let's go to 0%. Dividend payout rate. So you really can see the impact. Zero. There's no double taxation. So that makes sense, right? We're paying 21%. We're paying 21% on it, on the double taxation, because there is no personal income tax on dividends. So who benefits? Look who's paying more. The C Corp benefits greatly. There's no spendable income to the stockholders, but they're paying a larger percent. The reinvestment is less on the S Corp. Retained earnings is $1,040,000. Look at this. You get to reinvest 1.264. So that's double taxation. Let's go to 20%. Oh, there's no double taxation. 1-0. Let's go to 20%. Now we got a dividend paid out, $252,000. Well, you got to pay taxes, double taxation. Look at that, 21%. Now we pay 26%. That did not change, right? Even though this is incorrect, but it did not change, so it looks correct so far. Let's go to 40%, and you're going to see that amount going up. Now it's at 32% because now we distributed 40% of our dividends, and we got to pay another 35% on that. We pay 21% on our EBT, and now we got to pay 35% on the dividends, but it is still lower our effective tax rate than the S Corp. And then if I go to 50, roughly 53, now it's almost like the break-even point. And I wish I put an equation in there to find out the break-even point. It might be a little more complex than I wanted to get. But as you can see, the effective tax rate is almost equal if we distribute it roughly 52% of our, I don't know if I can hit that exact. There's an equation we could do, but around 51%, probably about 50.5% would be the same taxation. Look at that. Total taxes paid almost equal with each other in that regard. All right. So play around with that. You can see how the model works as you change the dividend. But now I'm going to include something that will change things up. I included interest because interest is on the income statement. A lot of these questions say, let's assume there's no debt. Not in my class. I like to see, I want to give you a functional model you can keep. And I want to see, well, what if we put 10,000 of debt? So let's see the impact. So if we put 10,000 in debt, we had to pay 10% interest. That's 1,000 interest. That lowered our tax burden because there's no taxes on interest. Well, it lowered the tax burden. Remember, it lowers the tax burden based on the 21% here and the 35% there. And if you scroll down, now you can see I did make a mistake, right? I made a mistake. It's 35%. That's not correct. If you introduce interest, it's not that simple to say we're paying 35%. Because we lowered our tax burden with the interest payment. There is no taxes on it. So what I do? I have EBIT, my earnings before interest and taxes. I subtracted out, let's make this a little larger. So it might look 100,000. Now we got to pay a 10,000. So now my taxable income is 10,000 less. That means I'm going to pay less personal income tax than I did with no debt. Of course, debt has other consequences, other negative impact, but one of the positive things is the tax shield. You don't pay taxes on it. So now what we got to do is we got to build this model on the S Corp to make sure it's proper. So I'm going to go equals. Now the taxes paid is going to be different, right? Because we multiplied the 35% by a lower amount than the EBIT. So I'm going to take that taxes paid, which is the same as right here, and I'm going to divide it by the EBIT. And as you can see, if you introduce interest, now things are going to change a little bit. We can keep it there. So let's say we had $1 million. $1 million loan. That means we're paying 100,000 on debt. And you can see, well, I'm still at that 51%, but you can see how it does lower the tax rate on both examples because of interest. Will it really make a big difference between the two? I assume maybe a little bit, maybe not too much, but you can examine how debt does impact our S and C Corp. Maybe not compare the two necessarily. With the two, the main concern is the dividend payout rate, which you will see a larger impact on it. So there you go. That's our video for today. Any questions, please let me know.